For decades, U.S. Treasury bonds have been the gold standard for safe investments, an IOU from the U.S. government, trusted by individuals, corporations, and entire countries. When the government needs to borrow, it issues these bonds, promising to pay back investors with interest. The world's faith in America's ability to pay its debts made Treasuries the ultimate safe haven asset. In times of crisis, global investors would flock to U.S. bonds, allowing America to borrow cheaply and easily. Foreign nations, especially those trading heavily with the U.S., would use their dollars to buy treasuries, managing their currencies and earning a safe return. This created a cycle. America got funding, and foreign countries got a secure place for their savings, reinforcing the dollar's dominance. But what happens if that trust fades? What if America's biggest lenders start to question the safety of those IOUs? Today, that once unshakable confidence is being tested. The belief in U.S. debt as the world's safest investment is no longer a given. If this foundation cracks, the effects could ripple far beyond Wall Street, impacting everything from car loans to job security. The global financial order built on trust in U.S. debt is showing signs of strain. The question now, can America maintain its reputation as the world's most reliable borrower? If not, the consequences could be felt in every corner of the economy. The world is watching and waiting. The stakes have never been higher. The era of unquestioned faith in U.S. Treasuries may be coming to an end. In spring 2025, global markets were rocked as foreign central banks began dumping U.S. debt at a pace not seen in decades. This wasn't a slow shift, it was a sudden, sharp sell-off that caught everyone off guard. The trigger? A dramatic escalation in the U.S.-China trade war, with new tariffs sparking fears of prolonged conflict. For countries holding vast amounts of U.S. debt, the risk suddenly felt too high. The stability that made treasuries attractive was now in doubt thanks to unpredictable U.S. policy. As foreign investors rushed to sell, treasury bond prices plunged and yields spiked. In just 1 week, the 10-year treasury yield soared from 4.01% to 4.58%, a massive move in the usually steady bond market. U.S. debt, once a safe haven, became a source of volatility. This wasn't just a blip, it signaled a deeper shift in how the world views America's financial leadership. For years, the U.S. benefited from being the world's safe haven. Now, dozens of central banks are diversifying away from American assets. The message, political and economic risks are rising, and the world's biggest creditors are looking for the exits. This retreat has profound implications for the U.S. economy. The era of easy borrowing may be over. America's financial dominance is no longer guaranteed. The global sell-off is a wake-up call. The world is rethinking its trust in U.S. debt. The numbers tell the story. Between March and June 2025, foreign official entities sold $48 billion in U.S. treasuries. In 1 week alone, $17 billion was dumped, a clear sign of growing unease. China and Japan, once the largest holders, led the exodus. By late 2024, Japan slashed its holdings by $25.6 billion, and China trimmed another $9.6 billion. In just 1 month, major players offloaded over $80 billion in U.S. government debt. This wasn't about currency management, the dollar was already weakening. Instead, it was a strategic move to reduce exposure to U.S. risk. The timing, right after new tariffs, shows these sales were a direct response to rising trade tensions. Foreign investors now hold about 30% of the $9 trillion U.S. Treasury market. Their participation is critical for market stability and government financing. But with this pillar of demand cracking, the U.S. faces a new reality. The world's confidence is shaken, and money is moving elsewhere. The U.S. can no longer take foreign demand for granted. This shift puts America in a precarious position. The Treasury market's foundation is no longer as solid as it once was. The numbers are a warning. Global trust is eroding. The U.S. must adapt or face the consequences. The sell-off is rooted in politics and fear of U.S. power. The new tariffs on Chinese goods in April 2025 were the spark, but the underlying worry is deeper. Could the U.S. weaponize its financial system? Countries like China fear their U.S. assets could be frozen or devalued in a dispute. In response, they're reducing reliance on the dollar and treasuries, buying gold, seeking alternatives, and diversifying reserves. This isn't just about China. Other nations are following suit, wary of unpredictable U.S. policies. Wall Street analysts also point to hedge funds amplifying the chaos, forced to sell treasuries as markets swung wildly. But even if hedge funds fueled the short-term spike, the real story is the strategic shift by foreign central banks. The world is rethinking the wisdom of tying so much wealth to a single, increasingly unpredictable country. No other market matches the size and safety of U.S. Treasuries, but the search for alternatives is on. This diversification is reshaping global finance. The U.S. can no longer assume it will always be the world's financial anchor. The fear of financial weaponization is real, and it's driving change. The global order is shifting. America's actions now have immediate worldwide consequences. The world is hedging its bets. The era of automatic trust in U.S. debt is fading. With foreign buyers stepping back, who's left to buy America's debt? The U.S. government keeps issuing new bonds, but someone has to absorb the supply. In early 2025, domestic broker-dealers and some foreign private investors stepped in, lured by higher yields. But U.S. households and hedge funds actually pulled back, showing a fragmented, uncertain market. These new buyers are opportunistic, not reliable long-term partners. Foreign central banks bought treasuries for stability. Speculators buy for quick profit. Relying on them is risky, and could mean more volatility. The supply of U.S. debt is growing, but the pool of steady buyers is shrinking. If foreign demand keeps falling, the U.S. may have to offer even higher interest rates. The question of who will buy America's debt is now urgent. There are no easy answers, only tough choices ahead. Fewer buyers for U.S. debt means higher interest rates, plain and simple. The government must pay more to attract investors, raising borrowing costs for everything from infrastructure to defense. These higher rates ripple through the economy, pushing up mortgage, car loan, and credit card rates for everyone. Families face higher monthly payments, squeezing budgets and slowing spending. Businesses pay more to borrow, making them less likely to invest or hire. Some may pass costs to consumers, raising prices on everyday goods. In tough times, job cuts could follow as companies tighten their belts. The era of cheap borrowing fueled by global trust may be ending. If so, Americans will feel it in their wallets and job prospects. The cost of waning demand is real and rising. The U.S. must adjust to a new, more expensive reality. As the sell-off rattled markets, Washington scrambled to reassure investors. Treasury Secretary Bessent downplayed fears of China weaponizing its holdings, blaming the chaos on hedge funds unwinding risky trades. He insisted the U.S. had tools to stabilize the market if needed. President Trump paused new tariffs, hoping to calm nerves and restore confidence. The administration claimed credit for easing the crisis, but deeper concerns lingered. The strategic shift by foreign central banks isn't going away. Official reassurances soothed short-term panic, but trust remains fragile. The world is watching U.S. actions, not just words. The future of the Treasury market depends on restoring predictability and reliability. Treasury bonds may seem distant, but their fate shapes everyday life. When foreign buyers sell, U.S. borrowing costs rise, and so do mortgage, car loan, and credit card rates. Higher rates mean bigger monthly payments and tighter household budgets. Businesses borrow less, invest less, and may raise prices or cut jobs. The world's trust in U.S. debt has kept American life affordable for decades. If that trust erodes, the hidden subsidy disappears. The sell-off is a warning. Economic stability is no longer guaranteed. Everything could cost more and jobs could be less secure. The financial ground beneath our feet is shifting. Everyone will feel it.